Go ahead.
All right, so my name is Alex Hutchings.
I'm Cody Anderson.
I'm James Kennedy.
Tom Martin.
This is our Poly One investor presentation. A brief overview before we start. We're going to go over our industry and business description for Poly One, followed by our financial analysis, our technical analysis, our valuation model, our final recommendation. For Poly One, we are recommending a hold position. Poly One operates in the basic materials sector where they develop and manufacture specialty chemicals. A breakdown of the revenue segments for Poly One show they are a relatively well-diversified company. Poly One distribution leads in revenue growth, but the other companies aren't very far behind, which we see as a very strong positive for Poly One.
So, as our hold recommendation would suggest, there are opportunities and challenges facing Poly One. So I'm going to begin today by discussing a little bit about some of the challenges. So we are experiencing slowing global growth, and GDP is forecast to decline. And as you can see, Poly One has 59% of its business in the United States, but the other 41% is overseas. So their end market is 46% in transportation, industrials, and building construction, which are three highly cyclical industries, and all three of those do have expecting slowing growth rates. So some opportunities from the industry. They offset negatives in transportation by creating things for like the trucking industry. They're making plastic materials that will make transportation more efficient, cheaper by putting plastic materials rather than the traditional metal sheeting, like for example inside of the truck trailers and things like that, and also aerodynamic pieces. And then packaging, they're also creating like the milk jugs that you see sitting on shelves. It allows for expiration dates to extend. And then they're also moving into things like healthcare that aren't as cyclical as their other sectors. And they're also making consumer products such as phone cases using TPU, which is a stronger plastic than what a lot of other phone case companies use. So they're basically moving out of those cyclical industries more and more. In their invest to grow policy, their acquisition process is also shown to be a success. As you can see, their commercial resources have increased by 40%, their operating income has increased by 150%, and their operating margins have increased by 900 basis points. Those are for the acquisitions that they've had for 7 years or greater.
So to go off from that, you can see here that I'm going to talk about the financials. And we're going to also start with some positives and some negatives. So I'm going to start with the positive, which is their profitability, going off what Cody was just talking about. Largely, you can see the huge increase in profit margin from 0.9% to 15.5% over the years. This operating margin has led to increases in other profitability ratios, such as ROA, ROE, ROIC, and it's allowed them to increase their dividends and repurchase shares. I'm going to go more in depth about the ROIC. We see this as a better indicator to investors. So we have here listed some peer companies. The next closest is Faro. So they dominate their peers within this industry. The median average comes in at 4.69, 4.58%. So they dominate in this section. But the challenges that they face is, although they've been increasing these profit margins, it's come at the cost of increasing their debt heavily. So despite the impressive margins that we just saw, they have the lowest grade compared to their peers, tied with Faro. The median is a B+. This is according to Value Line's financial strength. You can see that they're more levered than the rest of the peers by 70% more than the industry average. This is a trend, and if this trend continues, we can see that as concerning. It's because going off what Cody was just saying with the declining forecast in the industry, that's the worst time to be levered is when things are expected to decline. And the more they increase, the more it's going to cost, and that's going to eat into the impressive margins that we just saw.
So far, we've discussed a few challenges and opportunities to Poly One, and these pros and cons, if you will, are the backbone for what we believe is our whole recommendation. We're now going to discuss Poly One's technical analysis as well as our valuation models. So this is a one-year graph of Poly One's stock price. You'll see the Poly One stock price in blue. The stock price is 50-day moving average in red, as well as the 200-day moving average in green. For the first 8 months or so in this chart, Poly One stock price is fairly stagnant. what is interesting about this chart is the fact that in around October, we see the 50-day moving average moving below the 200-day moving average. And this is what's known as a death cross. And a death cross is historically a great indicator of future price declines. And lo and behold, that's exactly what we see here with the negative price momentum. In this 3-month period, which whenever Polygon stock was appreciating, their value was cut by as much as 30%. They have been able to bounce back above their 50-day moving average recently, but we do believe that the 200-day moving average is going to act as price resistance for Polygon stock. The next thing I want you to note is our targeted price range for our whole recommendation between $44 and around $28. So this is what we believe is the fair value for the stock. This is also what the investors believe is the fair value for the stock in the marketplace. And so too do the insiders in Polygon itself. So we see here that at around $43 per share, there were a number of CEOs and other board of director members who chose to exit a lot of their shares, sell them off, and that caused a large sell-off. And then at around early November, October area, they actually started buying back more shares. So we believe this confirms our valuation model for Polygon.
Using a discounted cash flow model, we computed a fair value price for Polygon of $34. In our model, we manipulated 3 specific factors. That was net margin, revenue growth, and terminal growth. We felt these were the most sensitive to macroeconomic trends, as well as the business strategy of Polygon. In order to account for all possibilities, we ran 3 different scenarios through our model. Our best case scenario assumed favorable market growth, maximum efficiency, especially in their rest to grow strategy, as well as ability to expand product segments into emerging markets. Our worst case scenario assumed unfavorable market growth, as well as inefficient acquisitions and inability to expand product segments. Our scenarios provided a price range of $28 to $44, $28 being the worst case, $44 being the best, and our base case falling rated between the $34. Throughout our model, we use a cost of equity of 13%. This is computed using a beta of 1.25, a market risk premium of 9.19%, and a risk-free rate of 2.74%. In order to confirm the range we found in our DCF model, we ran a relative valuation using price ratios. This computed a range of $29 to $43, which confirms our range found in our DCF model. The price ratios used in this model were signature ratios. So that's the median price ratio over the past 6 years. This was in line with the historical average, so we found it as an appropriate measure to use for this model. Our table here shows our signature ratios followed by our estimated per share value for 2018 and then the estimated price at the bottom. So our DCF model and relative valuation show that Polygon trades right around fair value. Our DCF model base case computed a value of $34 per share. A relative valuation using an arithmetic average and 4 price ratios gave us a value of $36 per share, and the price as of February 1st, 2019 was $32.37 a share, which confirms our whole position. Our final recommendation includes both opportunities and concerns for Polygon. Bulls would say the opportunities would be the strong business strategy, especially their acquisition strategy and their rest to grow. Their ability to increase profit margins and their increasing distributions, especially dividend growth year over year, as well as increasing buybacks, which make Polygon an attractive company. Concerns, bears would say, would be the increasing debt levels, the slowing industry growth, and negative stock momentum, which creates concern and uncertainty around Polygon. And we believe these create a wash against each other and therefore confirm our whole position.
Thank you.
All right, I'll start. Since that was the most recent slide, what, gun to your head,
Yeah.
what do you say?
What do I
Bulls
say?
say, bears say, what do you say?
We say that we see the positives, we see the negatives, but because there's equal amount of both, we say there's a whole. We don't see any overweighting factor with the positive or the negatives. So,
What are some qualitative risks that you see for the company?
I would say just the industry growth overall, as well as the debt levels, because if they aren't able to grow their profits and they have the increasing debt levels, it's going to become problematic in the future for them. As well as their negative stock momentum, which we see is negative.
Do you have an opinion about their most recent acquisition and what the pros and cons of that acquisition just announced in the last couple of months?
I would love to take that one. Yeah, that was on Fiberline. I think that is actually a tremendous opportunity for Polygon, considering they're getting into a lot of 5G. And I think 5G is going to be, and it's been proven that while in the next few years we won't entirely see the benefits just yet, but 4 to 5 years down the line, everything we use in terms of cellular data is going to be controlled by 5G, and Poly 1 is positioned to create the coding for the wires as well as the colorants for the wires. So I believe there's going to be a lot of market demand for their products in the next few years.
A lot of the, I mean, this is so difficult for us to try to predict the future, but a lot of predictions are showing a recession coming in 2020. Assuming that that would happen hypothetically, how does this affect, how would that affect your analysis? I noticed you had bulls and the bears and slowing industry growth, but how much would that be multiplied by a recession in this industry, which is very competitive to begin with? Would you think from their consumer or their clients, their clients? How
I
would
think their end markets are very affected by a recession. So building materials, transportation, things like that, consumer products, the recession would hurt a lot of those final, end consumers. So being so concentrated in those industries would definitely hurt their bottom line.
Then at the same time, they are also moving into things like healthcare, as I mentioned, which will be a more stable industry for them. So that could possibly offset some of the negativity if a recession were to occur.
What happens if interest rates go up and they're high debt level? You have to pay bigger interest rate. Couple that with a recession, would that affect your thinking on maybe saying hold or not hold? I'm thinking sell.
Yeah. So
And I know the price is beaten up and down, and that's less.
Right, yeah, so-
I think there's still some definitely positives, so I don't think you can just disregard those and say it's a screaming sell if we can predict that would happen, which is definitely difficult to do to begin with. So I think that there are some positives that should be overlooked, but they are definitely, as Alex said, it's like a wash. So
Yeah. It's good that they're diversified.
I mean, short term, yes. And we have been discussing this in our investment club at Gannon, the possibilities of recession, maybe not in 2019, but 2020. And we do believe it does have a lot to do with interest rates. And what we've been discussing is that, at least in terms for Poly 1, in the short term, that obviously wouldn't bode well for them. In the longer term, we do think they have potential growth factors, like you were saying about getting into healthcare and other end markets and stuff like that, as well as this new acquisition with Fiberline. We think their investor growth strategy has given them great opportunities in terms of making it profitable for them years on the line. So again, that's why we think it's a wash, because it's like, and that sort of gets back to our hold strategies, because we do believe that there are concerns for them right now, but we also believe there's opportunities for them. So.
Question. Well, a couple comments. I appreciated the price chart and the insider trading. I think that is useful information. So going to the DCF, can you talk about how the beta was derived?
beta was just taken right off of fact set. So that's how we took the beta.
Okay.
Go
Fact
back,
set?
go
Sorry,
back to
yep.
the estimates.
Yeah.
That.
Right here, yep. So the beta was taken right off our database that we were given for this CFA presentation, which is fact set, and so we just took the cost factor right off of that.
Okay, maybe trying to kill the onion a little bit. Do you have an idea on how FactSet determines that beta?
I do not know how to compute that beta.
And then, did you look at the betas of the peer group as well? And how did Poly 1 compare to them?
you didn't compare betas. So.
Okay.
So I like the fact that you gave us, some sensitivity
Right.
here, but I'm your fund manager, you're my analyst, right? And I want you to give me your best shot as to what are you coming down to the best or the worst or somewhere in the middle?
Yeah, our base case is our best shot.
Your best case is your.
Yeah, so our $34 fair value is our best shot. We just provided the ranges to incorporate different scenarios.
Yeah, that's my bet. So best case gets you 44, worst case gets you 20.
Yeah.
In terms of that analysis.
So on the DCF, the margin, the base case of 5%, where does that rank in terms of the historical ranges?
So that's pretty, given the past 5 years, that's pretty similar to what they've been growing year over year. So the base case would continue to be the same upcoming, given their new investor growth strategies, increasing their margins.
So a fair interpretation would be is the base case really isn't assigning much, because obviously management is going to come out and say we can increase the margins.
Right.
Here's how we're going to do it. But essentially there's a degree of skepticism on the team that is actually may not take place.
Right, yeah, so we factored that in. So management has their, their best case scenario, increasing margins. So we took kind of the in-between of where we saw the management as well as the factors that we talked about and incorporated that into our margin growth.
Any other questions?
You more than once pointed out, and I think correctly, and give you credit for the leverage and the fact that the ROIC is higher, but it came about through higher leverage. And you identified that as a risk. I guess I'm just wondering, based on your understanding of the company and the macro environment, how big of a risk is that? Is that? I guess that's the best way I can make a question. Is it just one of many? Is it top of mind? Is it, how big of a risk is that?
I think it's the biggest challenge that they face, and if they continue on the trend that it's showed the debt to equity trend, if they continue on that, then it's going to prove to be a bigger challenge, especially if things don't go as well in the future. But at the same time, they have better than their peer profit margins, so they have the opportunity to tackle some of that debt if they choose so. So it's up to them. If they forecast that things aren't going to go well and they want to be less levered, I think they can afford with the profit margins that they earn to maybe look at reducing it.
So if I'm the manager and I need to buy the stock and I got to be convinced that you're right and it's not a huge risk, right? But I'm not convinced. What metric might you show me that convince me that it's fine? What financial metric might you use to convince me that their leverage is okay?
Some financial strength ratios. I know Value Line had their financial strength rated at an E level, which is very low.
Yeah. Well, it's coverage ratios, right? So it's one thing to have rising debt, and that's important to identify. But if you have rising coverage ratios, perhaps you're okay.
Yeah, if you
If
have enough money to pay
profitability is
back
up,
the
if free
debt.
cash is up, maybe that will comfort me. So I think that would be.
In the next few years, though, I mean, in what we view as likely occurrence of a recession, that's probably a lot more hard for them to accomplish.
Yes, sir. Agree. Lastly, I'll just say, as a former fund manager, I would want my analysts to use any tool available to them, including technical analysis. It's a little risky to use technical analysis in the CFA presentation because there's a good number of people still think of it as sort of witchcraft, right? So just be aware of that.
Absolutely.
I'm open-minded to it. I think it's one of many tools, but
As long as you don't rely everything your total decision on.
Oh yeah, absolutely.
Then it becomes teams.
We appreciate that.
That's our time.
Perfect. Well, thank you, everyone. We appreciate it.